If you own unallocated silver, you need to understand something that most investors don't realize until it's too late. You don't actually own physical silver. You own a promise, a claim, an IOU from an institution that says they'll give you silver if you ask for it. But here's the problem that's keeping precious metals experts up at night. What happens when everyone asks for their silver at the same time and there's not enough physical metal to go around? Let me paint you a picture of what unallocated silver really means. Imagine you go to a coat check at a restaurant. You hand them your coat, they give you a ticket. But instead of hanging your specific coat on a hook with your number, they throw it in a big pile with everyone else's coats. When you come back, they promise to give you a coat. Not necessarily your coat, just a coat. And here's the kicker. They've given out more tickets than they have coats. That's unallocated silver. You have a claim on silver that exists somewhere in a vault, mixed with everyone else's silver, and the institution has sold more claims than they have actual metal. Now contrast that with allocated silver. That's like having your coat hung on a specific hook with your name on it. It's segregated. It's yours. Nobody else has a claim to it. And if you want to walk out with it, you can. The difference seems small on paper, but in a crisis, it's the difference between having wealth and having worthless paper. The London Bullion Market Association, the LBMA, runs on an unallocated system. It's the largest physical precious metals market in the world. Trillions of dollars worth of gold and silver change hands through this system. But here's what most people don't know. The LBMA operates on a fractional reserve basis. They hold physical metal, sure, but they've issued far more claims on that metal than actually exists in their vaults. How much more? Nobody knows for certain because they don't have to disclose it. But industry insiders estimate the ratio could be anywhere from 10 to 1 up to 100 to 1. That means for every ounce of physical silver in the vault, there could be 10 to 100 paper claims on that same ounce. Think about what that means. If even a small percentage of unallocated silver holders decide they want physical delivery, the system breaks. It's a bank run, but for silver. And we're starting to see the early warning signs that this could be happening right now. Before we go further, I want to make sure you're getting the full picture here. I've put together a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now to safeguard their savings from exactly these kinds of systemic risks. It's in the description below. Grab it while you're thinking about it, because what I'm about to show you is going to make you want to take action. Let's talk about what's actually happening in the silver market right now. Silver inventories at the LBMA have been declining. Not gradually, rapidly. We're seeing drawdowns that haven't been seen in years. At the same time, industrial demand for silver is at all-time highs. Solar panels, electric vehicles, 5G infrastructure, medical applications. Silver is being consumed at a rate that far exceeds new mine production. The Silver Institute reports that we're in a structural supply deficit. More silver is being used than is being pulled out of the ground, and that deficit is growing. But here's where it gets interesting. Despite this supply deficit, despite declining inventories, despite surging industrial demand, the price of silver hasn't exploded the way you'd expect. Why? Because the paper silver market, the unallocated claims, the futures contracts, the ETFs that don't hold physical metal, they create artificial supply. They suppress the price by flooding the market with paper promises of silver that doesn't exist. It's a shell game, and it works until someone asks to see the shells. Let me tell you about what happened in the nickel market. This is a perfect case study for what could happen with silver. The London Metal Exchange had a nickel short squeeze. A Chinese company had massive short positions in nickel. When Russia invaded Ukraine, nickel prices started spiking because Russia is a major nickel producer. This Chinese company couldn't deliver the physical nickel they'd promised. The price of nickel went from around $15,000 per ton to over $100,000 per ton in a matter of days. The London Metal Exchange had to halt trading. They canceled trades. They changed the rules mid-game to bail out the short sellers. People who had winning positions got wiped out because the exchange decided to protect the institutions that couldn't deliver physical metal. Now apply that to silver. The COMEX, the Commodities Exchange in New York, has massive short positions in silver. Commercial banks are short hundreds of millions of ounces of silver. If there's a delivery squeeze, if industrial users start demanding physical metal, If investors with unallocated silver start asking for delivery, the same thing could happen. Prices could spike, trading could be halted, rules could be changed. And if you're holding unallocated silver, you could find yourself with nothing but a cash settlement at a price that doesn't reflect the true value of physical metal. This isn't theoretical. This has happened before with silver. In the early 2000s, there was a situation where investors holding silver certificates from a major bank tried to take delivery. The bank didn't have the silver. They offered cash settlements instead. The investors sued. It took years to resolve. And the people who thought they owned silver found out they owned a legal claim that was worth far less than actual metal. Here's another layer to this. When you hold unallocated silver, you're an unsecured creditor. If the institution holding your silver goes bankrupt, you're in line with all the other creditors. You don't have a specific claim to specific bars of silver. You have a general claim on the institution's assets. And in a bankruptcy, unsecured creditors are the last to get paid. You could end up with pennies on the dollar or nothing at all. Meanwhile, people who hold allocated silver, segregated silver with specific serial numbers assigned to them, they have a direct claim to physical metal. They're not creditors, they're owners. Let's talk about counterparty risk. When you own physical silver in your possession, you have no counterparty risk. The metal is yours. It's in your safe, your vault, your hiding spot under the floorboards. Nobody can take it from you unless they physically break into your home. But when you own unallocated silver, you have massive counterparty risk. You're trusting that the bank, the vault, the institution holding your silver will be solvent when you want your metal. You're trusting that they actually have the silver they say they have. You're trusting that they won't change the terms on you. You're trusting that in a crisis, they'll honor their obligations. How's that trust working out in other areas of the financial system? We've seen banks fail. We've seen institutions that were considered rock-solid collapse overnight. We've seen governments confiscate assets, freeze accounts, change rules retroactively. And you're going to trust that your unallocated silver is safe? Here's what's happening right now that should concern anyone holding unallocated silver. Central banks around the world are buying gold at record rates. They're repatriating gold from foreign vaults. They're moving from paper claims to physical possession. Why? Because they understand that in a crisis, possession is everything. Paper promises are worthless. And if central banks, with all their resources and inside information, are moving to physical possession, what does that tell you about the safety of unallocated claims? The BRICS nations, Brazil, Russia, India, China, South Africa, they're working on a new currency system that's backed by commodities, including gold and silver. They're accumulating physical metal. They're not buying ETFs. They're not holding unallocated claims. They're taking delivery of physical bars and storing them in their own vaults. They're preparing for a world where paper promises don't matter, where only physical possession counts. Now let's talk about what happens in a real crisis. Imagine there's a major geopolitical event, a war, a financial collapse, a currency crisis. What happens to unallocated silver? First, there's going to be a rush to convert paper claims into physical metal. Everyone's going to want delivery at the same time. The institutions holding unallocated silver are going to be overwhelmed. They're going to implement delivery delays. They're going to offer cash settlements. They're going to change the terms of their contracts. And if you're holding unallocated silver, you're going to be stuck. Second, governments might step in. They might freeze precious metals trading. They might impose capital controls. They might confiscate metal from vaults. It's happened before. In 1933, the US government ordered citizens to turn in their gold. Executive Order 6102. People who had gold in bank vaults, in safe deposit boxes, they had to surrender it. People who had gold in their physical possession, hidden in their homes, they could keep it if they chose to ignore the order. Possession mattered then, and it will matter in the next crisis. Third, the price disconnect between paper silver and physical silver is going to explode. We're already seeing this to some degree. Physical silver coins and bars trade at a premium over the spot price. That premium has been growing. In a crisis, that premium could go from a few percent to 50%, 100%, or more. If you're holding unallocated silver and you try to convert to physical, you're going to have to pay that premium. you're going to lose a massive chunk of your wealth just to get the metal you thought you already owned. Let me give you a specific example of how this plays out. Let's say you have $10,000 in unallocated silver. You think you own about 300 ounces based on the current spot price. A crisis hits. You call your institution and say you want delivery. They tell you there's a 6-month wait, or they offer you a cash settlement at the current spot price. But physical silver is now trading at a 50% premium. So your $10,000 in unallocated silver is worth $10,000 in cash, but it would cost you $15,000 to buy the physical silver you thought you owned. You've just lost $5,000, 1/3 of your wealth, because you held paper instead of metal. Or worse, the institution tells you they can't deliver at all. They're insolvent. They're in bankruptcy. Your unallocated silver is now a claim in bankruptcy court. You'll get pennies on the dollar years from now, after the lawyers take their cut. Meanwhile, the person who held physical silver in their possession, they still have their 300 ounces. They can sell it at the premium price. They can trade it for goods and services. They have real wealth while you have a worthless legal claim. This is why possession matters. This is why allocated, segregated storage matters if you can't hold it yourself. This is why unallocated silver is a ticking time bomb. Now, I know some of you are thinking about retirement accounts. You've got silver in an IRA, and it has to be held by a custodian. You can't take physical possession. I get it. But here's the thing. Not all custodial arrangements are created equal. You can have a gold IRA or silver IRA where the metal is allocated and segregated. Specific bars with specific serial numbers are assigned to your account. You have a direct claim to that physical metal. It's not mixed with other people's metal. It's not part of a fractional reserve system. And if you ever want to take a distribution, you can get the actual physical bars delivered to you. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, and you're concerned about everything we're talking about, market instability, currency devaluation, systemic risk, I put together a comprehensive guide on how gold and silver IRAs work. It's in the description. It covers how to move funds from traditional retirement accounts into physical precious metals without triggering taxes or penalties. How to ensure your metal is properly allocated and segregated. How to choose a reputable custodian. It's worth checking out if this is relevant to your situation, because protecting your retirement savings from the risks we're discussing here is critical. Anyway, back to the unallocated silver problem. Let's talk about the mechanics of how this system works and why it's so fragile. The LBMA operates on a system of unallocated accounts. When you buy silver through the LBMA system, you're credited with a certain number of ounces in an unallocated account. The bank or vault operator holds a pool of physical silver. Your ounces are part of that pool, but they're not specific bars assigned to you. The bank can lend out that silver. They can use it for their own trading. They can hypothecate it, which means they can use the same silver as collateral for multiple transactions. This creates a situation where the same ounce of physical silver can be claimed by multiple parties. It's like fractional reserve banking, but for silver. And just like fractional reserve banking, it works fine as long as everyone doesn't ask for their money, or in this case, their silver, at the same time. But when confidence breaks, when people start demanding physical delivery, the system collapses. The COMEX has a similar problem. The COMEX is where silver futures are traded. A futures contract is a promise to deliver silver at a future date, but the vast majority of futures contracts are settled in cash, not physical metal. Only a tiny percentage of contracts result in actual delivery. The COMEX has physical silver in its warehouses, but it's a fraction of the total open interest in futures contracts. If a significant number of contract holders stood for delivery, demanded physical silver, the COMEX couldn't fulfill those deliveries. They'd have to default, or change the rules, or force cash settlements. We've seen this happen in other commodities. We saw it with nickel. We saw it with palladium. We've seen it with oil, where futures prices went negative because there was no physical storage available. The paper market and the physical market can disconnect violently when there's a supply squeeze. And here's the thing about silver. It's different from gold. Gold is primarily a monetary metal. It's held by central banks, by investors, as a store of value. Most of the gold ever mined still exists in bars and coins. It can be recycled and brought back to market. But silver is an industrial metal. It's consumed. It's used in tiny amounts in electronics, in solar panels, in medical applications. Once it's used, it's not economically recoverable. It's gone. This means the above-ground supply of silver is actually shrinking, even as demand is increasing. The solar industry alone is consuming massive amounts of silver. Each solar panel contains about 20 grams of silver. The world is installing hundreds of gigawatts of solar capacity every year. That's thousands of tons of silver being consumed annually just for solar. Add in electric vehicles, 5G infrastructure, medical applications, and you have industrial demand that's insatiable. And this industrial demand is price inelastic. A solar panel manufacturer isn't going to stop making panels because silver goes up 10%. They need the silver. They'll pay whatever it costs. This creates a situation where industrial users are competing with investors for a shrinking supply of physical silver. And when push comes to shove, industrial users will pay up for physical delivery because they need the metal to keep their factories running. Investors holding unallocated silver, paper silver, they're going to be left holding the bag. Let's talk about what you should do if you currently hold unallocated silver. First, understand exactly what you own. Read your contract. Read the terms and conditions. Do you have unallocated silver or allocated? If it's unallocated, what are the terms for converting to allocated or taking physical delivery? Are there fees? Are there delays? Are there minimum amounts? Know what you're dealing with. Second, consider converting to allocated silver or taking physical delivery. Yes, there are costs involved. Storage fees for allocated silver are higher than for unallocated. Shipping physical silver to your home has costs and risks, but those costs are insurance against the systemic risks we've been discussing. They're the price of true ownership. Third, if you're going to hold physical silver yourself, think about security. Don't tell people you have it. Don't post about it on social media. Store it securely. Consider a home safe, a bank safe deposit box, or a private vault. Diversify your storage locations. Don't keep all your silver in one place. Fourth, if you're going to use allocated storage, do your due diligence on the storage provider. Are they financially sound? Do they have insurance? Can you audit your holdings? Can you visit the vault? Are your specific bars segregated and identified? Get everything in writing. Fifth, understand the difference between pooled allocated and segregated allocated. Pooled allocated means your silver is allocated, but it's stored together with other clients' silver. You own specific bars, but they're in a shared space. Segregated allocated means your silver is physically separated from other clients' silver. It's in its own compartment or area. Segregated is more expensive, but it's the highest level of security and ownership. Now let's talk about the bigger picture. Why is this happening now? Why is the unallocated silver system under stress? It comes down to a loss of confidence in the financial system. People are waking up to the fact that the system is built on leverage, on debt, on paper promises that can't all be fulfilled. They're seeing inflation erode their purchasing power. They're seeing banks fail. They're seeing governments print money with abandon. They're seeing geopolitical tensions rise. And they're moving to hard assets, to things that have intrinsic value, to things they can hold in their hands. Silver and gold have been money for thousands of years. They've survived the collapse of empires, the fall of currencies, the destruction of financial systems. They're the ultimate form of wealth preservation, but only if you actually own them, only if you have possession. Paper claims on silver are not the same as physical silver, and in a crisis, that difference is everything. Think about the historical precedents. In Weimar Germany, people who held physical gold and silver survived the hyperinflation. People who held paper marks, bank deposits, bonds, they were wiped out. In Argentina, in Venezuela, in Zimbabwe, in every hyperinflationary collapse, physical precious metals preserved wealth, while paper assets became worthless. The pattern is clear. Possession matters. We're heading into a period of unprecedented monetary instability. Central banks have printed more money in the last few years than in all of previous history combined. Government debts are at levels that can never be repaid. The financial system is more leveraged, more fragile, more interconnected than ever before. When the next crisis hits, and it will hit, the flight to physical assets is going to be massive. And the people who hold unallocated silver, who hold paper claims, are going to find out that their wealth was an illusion. Let me tell you about a conversation I had with a bullion dealer. He told me that in recent months, he's seen a surge in customers wanting to convert their ETF holdings, their unallocated silver into physical coins and bars. These are sophisticated investors. They understand the markets, and they're getting out of paper and into physical. Why? Because they see what's coming. They see the supply deficits. They see the inventory drawdowns. They see the disconnect between paper prices and physical premiums, and they're acting before the crowd figures it out. Here's the thing about crowds. They move slowly at first, then all at once. Right now, we're in the slow phase. A few smart investors are moving from paper to physical, but when the crowd catches on, when everyone tries to convert at the same time, it's going to be chaos. The premiums on physical silver are going to explode. Delivery times are going to stretch from weeks to months. Some institutions are going to stop offering delivery altogether. And if you're holding unallocated silver at that point, you're going to be stuck. This is not fear-mongering. This is pattern recognition. This is understanding how markets work, how human psychology works, how systems break under stress. The unallocated silver system is built on confidence. It works as long as people believe they can get their silver when they want it. But confidence is fragile. Once it breaks fast, and there's no putting it back together. So what's the timeline here? When is this going to happen? Nobody knows for certain. It could be months. It could be years. But the structural problems are already in place. The supply deficits are real. The inventory drawdowns are real. The industrial demand is real. The paper to physical ratio is real. All the ingredients for a crisis are present. It just needs a catalyst, a geopolitical event, a major institution failing, a large industrial user demanding delivery and not getting it. Any of these could trigger the unraveling. And here's the insidious part. By the time it's obvious to everyone that there's a problem, it will be too late to act. The premiums will already be sky high. The delivery delays will already be in place. The institutions will already be changing their terms. You need to act before the crisis, not during it. You need to move from unallocated to allocated, or from paper to physical, while it's still easy to do so, while the premiums are reasonable, while delivery is available. Think of it like buying insurance. You don't wait until your house is on fire to buy fire insurance. You buy it when everything seems fine, when you don't think you'll need it. Because once you need it, it's too late to get it. Converting unallocated silver to physical is insurance against systemic failure. It's insurance against counterparty risk. It's insurance against the paper market collapsing. And the time to get that insurance is now, while it's still available. Let me address a common objection. Some people say, but I'm diversified. I have some unallocated silver, some allocated, some physical. I'm covered. That's better than being all in on unallocated, sure. But understand that in a crisis, your unallocated holdings could go to zero. They could be frozen. They could be confiscated. They could be settled in cash at a price that doesn't reflect the true value of physical metal. So your diversification might not protect you as much as you think. The only silver that's truly safe is silver you can hold in your hand, or silver that's allocated and segregated in your name in a secure vault. Another objection, but the premiums on physical silver are too high. I'm losing money by converting. You're not losing money. You're paying for true ownership. You're paying for security. You're paying to eliminate counterparty risk. And when the crisis hits, when unallocated silver holders are getting pennies on the dollar, you'll realize that premium was the best money you ever spent. It's like paying for a seat on the lifeboat before the ship sinks. It seems expensive until you're watching the ship go down and you're safe in the boat. Here's another way to think about it. The premium on physical silver is the market's way of telling you that there's a shortage of physical metal. It's the market's way of saying that paper claims are not the same as physical metal. It's the market's way of pricing in the risk that the paper market could fail. When you pay that premium, you're acknowledging reality. You're accepting that true ownership has a cost, and you're protecting yourself from the much larger cost of being stuck with worthless paper when the system breaks. Let's talk about what happens after the crisis. Let's say the unallocated silver system does collapse. Let's say there's a massive default, a delivery squeeze, a rule change that wipes out paper holders. What happens next? Physical silver prices are going to be multiples of where they are now. The people who held physical metal are going to have enormous wealth. The people who held paper claims are going to have nothing or close to nothing. And there's going to be a reset. A new system will emerge. Maybe it's a blockchain-based system where every ounce is tracked and verified. Maybe it's a return to allocated storage only. Maybe it's something we can't even imagine yet. But whatever it is, it's going to be built on the ashes of the old system. And the people who survived the collapse, who held physical metal, are going to be the ones who thrive in the new system. This is not just about making money. This is about preserving wealth across a systemic transition. This is about having real assets when paper assets fail. This is about being on the right side of history when the monetary system resets. And the choice you make now, whether to hold unallocated paper or physical metal, is going to determine which side you're on.